Thank you, everybody, for joining us today. I get to play host. This is my favorite type of webinar. I get to introduce somebody who's going to give us some great value today, and our topic is top tax secrets for the successful investor. So you may be on this call. You may already be an investor. You may not be an investor. Either way, stick around because you're going to get some value, and you're going to be able to take it with you and share it with others and hang out. So a little bit about what we do. First off, my name is Brett Sininsky. I'm a self-directed IRA and solo 401k consultant here at Sense Financial. We're a boutique financial firm that specializes in helping people unlock their retirement accounts to self-direct them into alternative assets. I'm going to talk about that for a few minutes. And just a little bit of a disclaimer, we're not a fiduciary. We don't provide legal, tax, or investment accounting or other professional advice. If you do need that type of advice, please seek out the proper professional. The good news is we have at least one of those categories represented here tonight, so you'll be able to ask some accounting type questions. But before we get into that, just a little bit about what we do. We've been around since 2010. We have kind of a niche within a niche. The niche is self-directed retirement accounts into alternative assets. The other niche is checkbook control. So we essentially either eliminate or bypass the custodian, allowing you to have full control over your investments and not have to go through that red tape of asking a custodian to do whatever it is they need to do as far as investing goes. And we have 5-star reviews all over the place. Our clients truly do love us, and we live off of our reviews and referrals. Most of our clients actually come from referrals from different areas, CPAs, financial planners, existing clients, of course. And over the years, we've assisted over 3,000 clients establish over 4,000 self-directed retirement plans. And so what are some of the benefits of the self-directed IRA or solo 401k? Well, I mentioned already, you can invest in alternative assets, which provides true diversification. You may think you're diversified if you're in, stocks, bonds, and ETFs, and to a certain extent you are, except you're really all in the stock market. And so what we allow is all of our plans allow the investing to be done into alternative assets like stocks, bonds, like real estate, cryptocurrency, precious metals, and that sort of non-conventional type of investments. And they're tax deferred, they're traditional tax deferred type accounts, or even Roth, which of course is tax-free. So the question is, do you want to pay taxes on the seed or the harvest? And I think most people would choose the seed if they can afford it. And so you can do Roth or tax deferred. And if you do want to buy real estate, you can leverage your investment with non-recourse financing, which essentially means the property is the only security for the loan. And again, checkbook control we talked about. Solo 401k is a true tax shelter because you can contribute up to $76,500 for 2024, tax deferred, or part of that can even be Roth as well. And just a quick touch on prohibited transactions. The Internal Revenue Code 4975 says that out of all the quote unquote alternative assets you can invest in, the only ones you can't do are collectibles and in the IRA only life insurance. And then furthermore, there are disqualified people, essentially a vertical line of descendants, you, your spouse, your children, their spouses, your parents, and your grandparents are all what are called disqualified people, which essentially means they cannot personally benefit from any investments or from the plan itself. And you can't do any work on behalf of the plan. And I could go on about that, but I'm going to leave it at that. And just a quick note on the unlimited investment options. I already mentioned some. You can buy and hold residential real estate, commercial, tax deeds. You can become a private lender. Many of our clients actually prefer the private lending as a vehicle for investment because of the passive nature of it. Some of our clients do cryptocurrency. Some of our clients invest in precious metals, but truly the only limitations I mentioned are collectibles and life insurance. And so it actually allows you true diversification. So hopefully you don't end up like this couple that I created from an AI software recently, and I thought it was kind of a cool graphic. But Ecclesiastes 11:2 says, "Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth." Of course, there's all kinds of turmoil going on right now, and assassination attempts on former presidents, and just crazy stuff going on, and who knows what's going to happen. Back in 2009, 10, even 2020 with COVID, the stock market went crazy, real estate went crazy. But if you were invested in enough diverse investments, real estate especially, you probably didn't see big dips in your portfolio like if you were in just one category or another. So with that said, I'm going to introduce my guest speaker here. Tony Watson is a tax consultant, and let me stop my share. And Tony Watson is with Robert Hall and Associates. He personally manages clients with over $500 million of real estate holdings. He has spoken for hundreds of trade organizations throughout the state of California, holding a federal license as an enrolled agent tax practitioner. Tony can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other entity with tax reporting requirements. And aside from his full-time position at Robert Hall and Associates, Tony is also an active real estate investor, entrepreneur, and enjoys short and long-term trading. With over a decade and a half of experience, Tony, along with his team at Robert Hall and Associates, actively look for the newest and most up-to-date strategies to implement on client tax filings. They all operate with the same goal in mind: to help taxpayers keep more of their wealth and not overspend with the federal and state revenue agencies. Without further ado, Tony, my man, thank you so much.
Yeah, thank you for having me. And usually I'm on here with Dimitri, but it's good to have some new faces involved in the marketing and webinar world. So thanks again for having me today. It's always a pleasure to come and speak for the Sense Financial group. A clientele, if you're new to Sense Financial, if you've been with Sense Financial for a long time, you might have even heard me speak on another platform somewhere, because I do speak at over 140 events on an annual basis. Tonight's topic, and you can see my screen right on your end. Am I good? Yeah, good. Okay, so I love it when technology works. So tonight's topic is near and dear to my heart, near and dear to all of my clients' hearts. It's the top tax secrets for real estate investors. We're going to talk, obviously, over the next 45 minutes, not in detail of internal revenue code, but things that I think are the bullet points, kind of the cliff notes as to what you should be looking for as a real estate investor when you are starting to build wealth, plan for retirement, some kind of tricks of the trade as I've learned over the past, almost 18, 19 years of doing taxes with Robert Hall and Associates. So without further ado, a little bit about Robert Hall. We've been around since 1971. Obviously, we're not a fly-by-night firm. We are not a seasonal firm where we only open for tax season. We are open year-round. And we service roughly around, I think now, about 11,000 tax filings per year. We've got great reviews online, so you can check us out at roberthalltaxes.com. I by no means am a one-man operation. I work alongside a wonderful senior consulting staff. We've got about 55 employees here at Robert Hall and Associates, and obviously we need that kind of team put together to service the 11,000 plus filings that we handle on an annual basis. And it's not just California tax filings, it's tax filings across the U.S. in all 50 states. I myself service filings probably in the 35 plus states. But as a firm as a whole, we do actually have clients across the U.S. in all 50 states. We saw a lot of clients uproot themselves from California and move out of state during the pandemic. So a good chunk of my clientele, even though they left California, I'm still here available to help them with all of their income tax filing needs, especially when it comes to planning. When they're exiting out of a state or entering into a state, there's a lot that is involved in the tax code, especially when you are leaving a state like California. California wants to follow your investments for as long as possible And as long as you're alive, if you dispose of assets that were originally California assets, there may even be some clawback clauses that California can implement to basically force you to pay tax on all of the capitalization or the capital appreciation that you've had on your investments while they were California assets, even though you haven't been in California or had assets in California for, 10, 15, 20 plus years. So lots of things to understand about the uniqueness of California's tax code and also the tax codes across the 50 states. A little bit about me. I've been here once again going on 2 decades. I am a public speaker as well as an enrolled agent tax practitioner. Once again, like the intro you heard in the intro, I do service tax filings in roughly the 500 million in managed real estate and other business dealing range, and speak at over 140 plus events on an annual basis. We're very much a one-stop shop for all of your financial needs. We obviously have our number one service, which is tax preparation. We do also incorporate businesses as LLCs, S Corp, C corporations. We do internal auditing, our financial planning and estate planning and year-end planning, like our connection with Sense Financial. We work closely with a lot of just fantastic, phenomenal vendors and that we've vetted and that we've worked with for over a decade. I've known Dimitri and Sense Financial for well over 10, probably even now 15 years in the making. So we only work with vetted out vendors and referrals for our clients, and we make sure that we're connecting them with the right professionals. Full disclaimer, I'm not an attorney. So today, even though you might think that I'm giving a little bit of legal advice, I want to make sure that you understand that all of what I'm speaking on today is solely from an income tax and revenue perspective. I tried not to step out of my lane of expertise. If I do, I apologize. But please, if you take any of the advice or the information today and apply it and think that it's somewhat on the legal side of advisory, please double check with your legal advisors, your attorneys, your trusted advisors to make sure and just double check on the legal side of things. Anything income tax wise, an attorney is going to send you to a person like myself or Robert Hall and Associates. But on the legal side, I have to defer all of the legal advice to the attorneys, the people who you pay a lot of money to keep you out of trouble, right? So hopping right into it, let's talk about some of the top tax deductions as real estate investors, as even real estate professionals, as we enter into Q3 and Q4 of 2024. I've been telling people this, and I do a lot of webinars, but I've been telling people this over the last couple of months that 2024 is going to be a very unique year. We don't actually have a tax code, a final tax code in place for 2024. There are several bills that are being held up at the Senate level right now. We have an election coming up on November 5th. There's going to be a lot of change over the next couple of months. And so I want everybody to be aware that the top 5 tax deductions, this is basically a consensus over the past 15 to 20 plus years that I've worked with Robert Hall, but mostly coming out of the pandemic. There was a lot of shifting in spending for real estate investors, real estate professionals and real estate investors. And I want to make sure that you maximize these deductions as you enter into the year-end planning portion of 2024, which year-end planning, it's never too late, right? I guess December 31st would be too late, but even on December 31st, I've had clients email me or text me or call me or hit up our office and say, hey, listen, is it too late to fund a retirement contribution? No, let's get you scheduled with Dimitri. Let's make sure that money transfers over prior to midnight on December 31st. We've been there. We've done that before. So, but give yourself enough time, enough leeway to put a plan in place to ultimately help you reduce that liability that you are currently on track to owing down to as close to zero as possible. This is the best way to help you retain wealth and not, once again, overspend with Uncle Sam and the state revenue agencies. Number one deduction that probably changed the most coming out of the pandemic, especially because people were forced to work from home, is marketing and advertising. The federal government will allow you a dollar for dollar reduction in taxable income for every dollar spent in marketing and advertising costs. So we saw a lot of people plugging in. I mean, we're talking about tens of thousands, if not hundreds of thousands of dollars into marketing and advertising their real estate businesses, their property management companies, you name it. People were really trying to hit new website development, Google Analytics, you name it. We saw it coming out of the pandemic and still continue to see it, even though we're kind of post-pandemic. Even though I had COVID like 3 weeks ago, COVID is still alive and doing very well. Both my parents had COVID 2 weeks ago, and that was a whole mess in itself. So COVID is still around, but we are now getting back to that, shaking hands, going to in-person events. I'm doing in-person seminars at local real estate agencies again. So we're feeling a little bit of normalcy, but the expensing on the business side is one and the same. I saw a direct correlation between people who were plugging money into marketing and advertising during the pandemic, and the businesses that were losing money weren't investing in marketing and advertising, whereas the clients who were double, triple, quadrupling their revenue during those very strange times in all of our lives, it was mainly because of the money that they reinvested back into their business's infrastructure, mainly into marketing and advertising. So marketing and advertising, great dollar for dollar federal and state write-off. It will help you retain wealth and keep more money in your pocket. Number two, professional supplies and equipment. It doesn't matter what industry you're in. I doubt that you can do what you do professionally without a laptop. Right? Kind of silly to think about. I doubt that you can do what you do professionally without a cell phone, without a desk, without a chair, without a filing cabinet, right? These are some of the most common business deductions out there. The government knows this. That's why a computer purchase or a cell phone or a desk or a laptop or a desk or a chair, filing cabinet, these are why these items have the lowest audit risk. In fact, in almost 20 years that I've been working with Robert Hall, I have yet to see an audit on a laptop purchase. I've yet to see an audit on a monitor purchase. I'm using a new camera, which is having some lighting issues today for some reason. This camera is a dollar for dollar deduction for me because I have to have it to do what I do professionally. Same with the little lighting kit that I tried to jimmy rig right before we started. But these are all some of the most common deductions, especially because people during the pandemic were forced to work from home. We had to upgrade our IT security software. We had to upgrade our internet speed. We had to upgrade our hardware and our computers, everything. And so once again, this will continue to be one of the lowest audit risk items on an individual, either Schedule E rental property return, because you have to have this stuff to manage your real estate, and or Schedule C, LLC, S Corp, or C Corporation. So keep that in mind. Make sure that you're maximizing these deductions as much as possible. Number three, car and truck expenses. For most real estate professionals, your go-to auto and truck deduction is going to be business mileage, which is deducted at a roughly 60 to 62 cent per business mile range. I think it's about to increase to either 64 or 65 cents. Once again, we don't have a final 2024 code. Even though you might Google 2024 tax code mileage deduction, that's not set in stone because it's only July 16th, and November 5th is going to change a lot of what happens with the tax code in 2024. So keep that in mind. Most of us will lean on the mileage deduction as a write-off for auto and truck. Some of us will be out shopping for a new vehicle. My wife's SUV, I've got two small kids at home. The SUV is kind of on the fritz. So we're looking for a new asset, right? A new large vehicle, which we will title and insure and pay for under my wife's corporation to take advantage of some of the accelerated bonus depreciation write-offs for heavyweight vehicles. If this particular conversation is something that you need to have with your tax advisor to figure out creative ways to deduct a new auto purchase or maybe even buying out a leased vehicle, have this conversation with your tax advisor. Call Robert Hall and Associates. There's very much a right and a wrong way to purchase a vehicle. If you are a business owner, if you are a real estate investor, you got to make sure you title, you insure, and you pay for it in specific ways to bulletproof that deduction and not miss out on probably one of the largest adjustments to taxable income, which is that bonus depreciation on a vehicle purchase. Okay, so keep all of that in mind. Number four, legal and professional fees. Back in 2018, under the prior Trump administration, right, because he's running again, so he might win in November, but under his previous administration, when he was in office in 2018, he introduced the Tax Reform Act of 2018, which eliminated a lot of expenses for W-2 employees. So in 2018, when this code was being discussed, we had a lot of calls, emails about how their advisory fees were no longer tax deductible, how their tax preparation fees were no longer tax deductible. Well, that is true if you are solely a W-2 wage earner, but if you are a self-employed individual, a rental property owner, real estate property flipper, manager, it doesn't matter what you are, as long as you have rental income or cash flow or self-employed income, legal and professional fees are still a great dollar for dollar write-off for you. Not for every taxpayer in the US, but if you have business revenue, real estate revenue, or self-employed revenue, our fees, tax preparation fees, broker fees, attorney fees, still great overall dollar for dollar tax deduction. So keep all of that in mind. Number five, last but not least, property deductions. in that 2018 bill, there were some major changes to mortgage interest deductions. There was a cap on property taxes, which was called or noted as the SALT deduction, state and local tax deduction. And so all of that is still very much in play. I'm looking forward to seeing what the next administration, whether it be Biden for a second term or Trump for a second term, but a new term, so to speak. I'm excited to see what changes there are for the SALT deduction, which right now currently is limited to $10,000, which is absolutely insane. That means that only $10,000 of your primary residence property taxes and including a second residence property tax, not rental properties, but a primary and a second personal use home, max deduction for property taxes is $10,000. And that actually not only includes property tax deductions, that includes all of the state income tax that you pay to the state of California as well. It's capped at 10 grand. I have no idea where they came up with that $10,000 cap. It should be closer to $50,000 to $60,000+. Biden had talked a little bit about, under the Inflation Reduction Act, increasing it to $80,000, but then he dialed that back because I think that the current administration, the Biden administration, knew that if they had increased that SALT cap to $80,000, the only two states that would really benefit from that change are us, California, and New York. The rest of the U.S., you could still move to other places. I just got an email before I hopped on the webinar about a client wanting to purchase a $350,000 investment property, not here in California, but elsewhere in the U.S. You're not buying properties at $1 million+. Sure, they have $1 million properties in other states, but it's just not as common as California and New York and Hawaii. Actually, we'll throw in Hawaii as the third state. So I'm hoping that in 2024, if not in 2025, that SALT deduction limitation really, is increased to something more reasonable, which will allow California and New York real estate owners to receive a much larger deduction for their property taxes. Another change in 2018 was the limit on mortgage interest, first position mortgage interest deductions on a primary residence and a second home. Prior to 2018, there was already a limit in place. You were only allowed the interest on the first $1 million of acquisition debt. In 2018, if you had purchased, a new bill or a new code was put in place where it said if you purchased a home, primary residence, or a second personal residence after December 15th of 2017, you are only allowed the mortgage interest on the first $750,000 of first position debt and not the $1 million limitation that was prior to 2018. So there was a little bit of shift on the federal side. California never conformed to that part of the code, thank goodness. So on the California side, you're still allowed the interest on the first $1 million. But on the federal side, you have to limit that interest deduction to the first $750,000 based on when you purchased that property. Remember, after December 15th of 2017. If you bought your home prior to December 15th of 2017, you're grandfathered into the old code. You still are allowed the interest deduction on the first $1 million of acquisition debt. Now, once again, that's on a primary residence, your personal home, and a second personal residence. This does not apply to rental properties. That is one of the powerful positions of investing in real estate for investment purposes, right? Owning cash flowing either commercial or residential properties. There is no cap to your property tax deduction. There is no limit to the mortgage interest write-off because you now own a business. It is not a personal asset. So keep all of that in mind. Make sure that you're working with tax advisors who know these limitations and they're applying these limitations to the return, because the IRS has special divisions that are put in place to audit mortgage interest deductions that seem to be written off above those thresholds. Some of these notices that we're getting, even if a client is grandfathered into the old code, sometimes we'll get a letter from the IRS stating, hey, this is a TCMP audit, where it's kind of a phishing audit form, where they send the letter to the client. They say, hey, listen, your mortgage interest seems a little high. We see the 1098 in our system showing a certain loan amount. Prove to us that this is 100% tax deductible. Those are the easiest audits to close out, because we simply send them proof of the payments of the mortgage. We send them a copy of the 1098. We send them a copy of the loan agreement from the bank, and then it washes out the audit. The field audits are the ones that you really have to worry about, because they're picking and choosing multiple things off of your individual return and business returns. And then you got to put together all the information. We go and represent you in front of the IRS. You don't go and represent yourself, but you hand over the documents to us. We go and fight the good fight for you. But you got to make sure that you're working with tax advisors who understand some of these limitations. I'm hoping that there will be some relief coming out of this pandemic. I have no idea why they didn't give relief on this end during the pandemic. Because remember, this is a part of the code from 2018. This was 2 years prior to us even knowing anything about COVID, right? So Obviously, there was no change during the pandemic years. So I'm looking forward to seeing what 2024 and 2025's tax code have in store for us, especially as of November 5th. We'll have to wait and see on that. And I'm sure that Dimitri and Sense Financial will have me back, and we'll have Dimitri back to talk about any changes in the solo 401k world when that all happens. I wanted to talk specifically also about the real estate professional status. It is not the Wild West, folks. I've talked to people in person about this. I've spoken about this in webinars, over the past probably 13, 14 years that I've been doing seminars. And people always have this Q&A with me about what qualifies them as a real estate professional, or what do they need to do to qualify as a real estate professional. And I always tell them it's not the Wild West. You can't just plug your information into a tax return, start checking boxes, and see what helps reduce your liability or see what helps accelerate certain deductions. You got to make sure you meet the requirements before checking this particular box. The real estate professional election is one of the most audited elections on an individual return. In fact, by checking that real estate professional box, you increase your audit risk on that form because of that election by upwards of 70+%. You don't want that, obviously. So if I see a return, or if any of my associates, the senior associates here, see a return, and we go through our Q&A, hey, do you spend more than 700 hours working with real estate related activities? Is 51% or more of your income generated from real estate activities? Is 51% or more of your time spent on an annual basis working with real estate related activities? Then you may qualify as a real estate professional. But we got to look at a bunch of other things on your individual tax return and Q&A with you before checking that box. Because when you check that box, what you're telling the federal government is that you specifically, out of all United States taxpayers, that you specifically receive benefits that like 95% of American taxpayers do not receive. And by checking this box, if you do have rental real estate investments that show losses, basically when you check that box, it unleashes all of your real estate losses to offset any and all other income on your individual return. Let me give you an example. Let's say that I am a real estate professional. My wife is a brain surgeon, right? My wife has $1 million W-2. I use her $1 million W-2 income to invest in real estate. I'm the real estate professional. We file a joint tax return. Her $1 million W-2, it is what it is. It pays federal, state, Social Security, Medicare, state disability, all of those crazy taxes that W-2 employees pay. But as a real estate professional, I take that revenue that she makes, all of that wealth that she's building up for our family, and I buy a portfolio of real estate, let's call it 20, 30 properties. And I go through the rigmarole of, leasing them out, and I choose to accelerate certain deductions and improvement costs. I maybe even do a cost segregation election to accelerate depreciation. And let's say that in this 30, 40 property portfolio, I'm able to accelerate $1 million of deductible losses and or depreciation all in, right? Well, if I don't check that real estate professional box, we have the $1 million W-2 and the $1 million loss that I'm using as an example. Because I'm not a real estate professional, I have to kick that loss down the road. I'm not allowed any of that loss because our joint income is too high to allow for any real estate related losses. But because I'm a real estate professional and I check that box, that $1 million loss adjustment is a dollar for dollar offset to my wife's W-2 income. That is the power behind the real estate professional election. So once again, it's not the Wild West. You just don't want to start checking boxes to see what gets you more back or reduces your liability. You got to make sure you're making the right elections on the return, because obviously you see the power behind that. Being able to offset a spouse's $1 million W-2 with $1 million in depreciation, property tax, mortgage interest, improvement costs on our real estate portfolio, and pay nothing in tax, but still make $1 million. That sounds like a pretty great deal to me, right? And that is fully the power of that real estate professional checkbox. Have this conversation with your tax advisor before you start checking those boxes on your return. Make sure that you're working with a legitimate tax professional who just isn't trying to impress you with the high refunds or the low liabilities. It is not the right time to start, thinking that the tax code is the Wild West, especially with AI technology being adapted or adopted into the governing systems. It's only a matter of time before the IRS's computer systems start to use AI technology to audit individual returns. You got to bulletproof things. And trust me, I'm just as aggressive as the next tax professional, but I want to apply the benefits under the current Internal Revenue Code to our benefit. I want to play the chess game with the IRS and utilize the code to our benefit, not try to cheat the tax code. That's the wrong avenue to go down. That's the wrong path to walk down. So just keep all of that in mind. What we saw a lot of during the pandemic is people, once again, moving out of California, or maybe not moving physically out of California, but taking their California dollars and investing them elsewhere. And one of the general misconceptions is that, hey, as a California person with my California wages, if I buy real estate in Nevada, hey, Nevada has no state income tax. I won't have to pay any income tax except for the federal income tax on whatever my profit is. Wrong. Okay. California is one of about 7 or 8 states that taxes its residents on their worldwide income. So I can take my California dollars and invest in Texas and Nevada and Florida, all of these non-taxed states, and own these great real estate investments in this portfolio across the US. But California says, okay, well, if Nevada doesn't have any state tax and Texas doesn't have any state tax and Florida doesn't have any state tax, well, that's fine that you pay no tax to them. But because you're a resident of California, you register to vote here, you drive around a car with California plates, you have a California address on your driver's license, guess what? As a California resident, I got to pay my tax to the state of California on the revenue I generated elsewhere in the US. Now, if I own a property in a state that has state income tax and I pay state income tax in that state, I do get a credit on my California return. So I will never pay tax in 2 different places. I call it the double taxation treaty. That's usually a foreign term when I invest outside of the US or I work outside of the US and I don't have to pay tax in that country and the US. United States have double taxation treaties. So if you pay tax there, you get a state tax credit on the California return, so you don't pay taxes in 2 places. You can go elsewhere for greater asset protection laws if you are incorporating in other states. But once again, it depends on what state you are registered to vote in, where a majority of your income is generated, right? And where where your domicile is. That's the term on the tax return, where your state of domicile is. And if you cannot prove that you spent 51% or more of your time outside of the state of California, you can't prove that 51% or more of your utility records are paid in a different state, 51% or more of your credit card transactions are transacted in another state, then by definition, California can step in and say, no, by definition, you are a California resident. So just be aware of this, have this conversation with your tax advisors. Like I said, I had just in my personal clientele roster, about 30+%, I'd say, of my clients leave the state of California during the pandemic and move their funds elsewhere, just getting out of the highest tax state in the US. So just be aware that there are some hoops that you have to jump through, and you got to do it the correct way in order to reap a lot of these benefits by moving to a non-taxed state. Let's talk really quickly about the main differences between the 3 things that you see here on the screen. It's the best analogy that I've been able to put together over my 13-year career of doing marketing. Been doing this almost 20 years, but 13 years of marketing and webinars and seminars. A lot of people get confused about the 3 options that they have that they see here on the screen. And I just want to mention that when you kick open these doors, the rooms do not connect, right? They lead you into a room that's filled with separate benefits to you, the taxpayer. The first and foremost important thing for you to have is the insurance policy, right? We have car insurance in case we get in a car wreck. We have health insurance in case we get sick. We have malpractice insurance, liability insurance, hazard insurance, fire insurance, earthquake insurance, and it's costly for us, right? But the insurance policy actually has a monetary compensation at the end of the day in case we need coverage for health insurance. My daughter during the pandemic, born in 2021, she was born and she had a heart defect. And so we had to have open heart surgery during the pandemic. It was kind of a crazy time in our lives, my wife and my life. She's fine now, which is great. She's growing stronger every day. But thank goodness, I'll even say thank God, I had the correct health insurance, because when I started getting those medical bills from Children's Hospital, they were in the $500,000 range. And sure, I have a great career, but there's no way that I could possibly have ever afforded $500,000 in medical bills, because they had to patch up my daughter's little tiny heart, right? But thank goodness we have that. That's why we have insurance. We have insurance, and it is there in place to pay out settlements in case an unforeseen event happens. And that's the importance of insurance. So it's the most important thing for us to have. Now, an insurance policy is not like an LLC. An LLC is not like a trust. An LLC, I'm meaning an incorporated entity, whether it's an S Corp, C Corp, or an LLC. LLCs, S Corps, and C Corps have no monetary payout at the end of the day in case you're sued or in case something happens, right? An unforeseen event happens. But what an LLC and an S Corp and a C Corporation do is they allow you to separate business and personal assets. So the more you separate your business and personal assets, the better protected you are. That's why a majority of real estate investors will set up LLCs for each of their rental properties so that they are separating the liabilities, separating the assets from each other. If a tenant sues your one property, they can't come after the 6 other properties that you own in 6 different LLCs, right? So asset separation equals asset protection and vice versa. I'm not saying that you should all go out today and set, if you've got 6 properties, to set up an LLC for each property. You got to have this conversation with not only a legal advisor, because once again, there's really no tax benefit for setting up an LLC for a rental property. You're just creating greater liability protection for the property itself. So it's more of a legal benefit. So you want to talk with a tax advisor, a legal advisor. And then once you've talked to the legal advisor, they give you the thumbs up to incorporate, and you transfer title, and you check with the lender to make sure that it's okay to transfer title into the LLC. Then you come to the tax advisor. We talk about all of the California filing fees for incorporating in the state. We talk about the filing requirements, the deadlines for certain returns. So we're kind of second in the conversation line when it comes to incorporated asset or incorporated entities. A trust is not like an LLC. A trust is not like an insurance policy. One major life event has to happen before a trust or an estate kicks in and provides you the benefit. And in fact, let me take a step back. It's not providing you the benefit. It's providing your next of kin the benefit, right? Your beneficiaries. That's why they're called beneficiaries. They're the ones that benefit from all the wealth that you've built for yourself over your lifetime. You want to make sure that if you have the insurance policy that is in place that you're paying a premium for, that's protecting the large asset owned under the LLC, that the ownership of the LLC is not you personally. The ownership is actually the living trust or the estate. And that way, if heaven forbid anything happens to you, that one major life event, which is death, and we all will see that day someday, right? We'll all pass away. That's one of the unfortunate parts about living. But the trust is really to protect your assets in death. It's meant to basically catapult the assets into this trust vehicle, and the trust vehicle is keeping your assets from going into probate here in the state of California. This is where I'm stepping a little bit out of my lane of expertise because I'm not a legal advisor, but I do know a little bit enough to just advise, but definitely check to make sure that these types of structures are correct for you in your specific scenario. But the trust is really meant to protect you upon death, to shelter your assets for your surviving spouse and or for next of kin. And that way California can't get their sticky fingers on your assets in death. And that gives your heirs, your beneficiaries, enough of a period of time to mourn the passing of a loved one, and also to protect all of the wealth and the assets that you've built for yourself over your lifetime, right? So having all 3 of these things in place is definitely beneficial, not right for everyone, but there's very much a right and a wrong time to have all of this stuff set up. I can't stress this enough before I go to the next slide. I can't stress this enough that people will log into a webinar or they'll go to YouTube or see on TikTok that there is a benefit for incorporating as an LLC, an S Corp, or a C Corporation. I love the fact that people are interested in all of these things, but you just have to understand that a TikTok video that's seen by 1 million people, there are 1 million different scenarios in those 1 million viewers, right? The advice is different and unique for each individual taxpayer. Sure, there might be some duplicates in there, sprinkled in that $1 million or million number amount of viewers. But at the end of the day, your scenario, your situation is unique. It's specific to your life. And so the advice needs to be tailored to benefit your situation, not your neighbors, not your coworkers, not the person you follow on YouTube or TikTok, not even an advisor. Like, I'm being very general with my advice right now. That's why I'm pushing people to really reach out and talk with us on a one-to-one basis, face-to-face basis, because we need to understand more about your specific situation and your scenario. So by no means am I giving you all generic advice that you should go out and implement. You should absolutely follow up if you are interested in talking about any one of these things that you see here on the screen, whether it's right for you or not. Set up a free consultation with Robert Hall & Associates. We'll go through all of that Q&A with you, okay? One very unique tax deduction, and I'll call it even a tax shelter, that I saw more so during the pandemic years than probably in the 14, 15 years prior to the pandemic of my career, is the interest in cost segregation elections. Now, some of you in today's seminar, how many people are in here today? We have 50 people logged in. So hi to everybody who just is logging in. Out of the 50 people in today's webinar, some of you probably have heard of cost segregation before. Cost segregation is not right for everyone. I just want to get that out in the open. Cost segregation is a very unique election on a return to take depreciation on a property and accelerate it to take it all in 1 year. Now, some of you might be thinking, well, depreciation is great, but what if I sell the property? I'd have to recapture that depreciation, pay tax on it. And as a tax advisor, I come in and say, well, there's always a 1031 exchange, and that kicks the tax can down the road until you kick the can. And that's the whole goal, is if you do end up moving forward with an election like cost segregation, you probably don't ever want to sell the property, right? You want to leave it for your heirs in death, because then they get a whole stepped up basis benefit and they avoid paying tax on it. But, you want to kick that tax can down the road until you kick the can and allow the benefit to go to your beneficiaries. Here is how cost segregation works for those of you who have not heard of cost segregation before. This is a real life example, by the way. This is a client of mine. I'm not going to name a name. He might even be on today's webinar. Who knows? But this is a real life organic example, right? With a client of mine, a new client that came to us actually in 2022 to do the 2021 return. And he had sat down with us digitally, because it was the pandemic year. Digitally, he sat down with us. And we mapped out his return. I plugged in all the numbers and I said, hey, listen, your 3-property portfolio is cash flowing about 33 grand. And so he's already done all the improvements to the property. He really wants to reduce liability as much as possible so he can buy more real estate. He's already set up his retirement and everything he's actually an LADWP worker here in Los Angeles. And he's already set up his deferred comp through his W-2. So he's really already maxed out everything he knew about prior to us meeting. And so I plugged in the numbers in the return, and I have my ideas and plans in the back of my mind, but I wanted to show him what the bottom line results were if I didn't implement any of the strategies that I had ready to talk to him about. So if we did nothing, if we implemented nothing, he was owing at the start about $4,000 to the IRS. He was owing about $4,200 to the state of California, so about $8,300 in overall federal and state income tax. This LADWP worker, very open with me, says, I don't want to work for LADWP any longer. I want to put money aside. I want to buy more real estate. I'm really good at this. I'm good at analyzing property cash flow values. I get good rates. I know a ton of real estate professionals. I know a ton of contractors that can do work for affordable prices. And remember, this is back in 2022. I haven't met with him this year for 2023's tax return. I don't know how costly it is to repair properties these days in his neck of the woods, but I know that cost of labor has skyrocketed. So maybe the scenario has changed a little bit. But, he says, Tony, is there any way that we could reduce this liability? Because I want to buy more property. I want to actually have more cash flow so that I don't have to work for LADWP much longer. So I said, you know what? You are not a perfect candidate for cost segregation, but I've mapped out a scenario for you, and we'll go through that scenario in the next 2 slides and make sure that it works for you, because it's not going to work for everybody. Because this client is not a real estate professional, he's an LADWP W-2 wage earner, he's going to have some limitations as to what he can deduct loss-wise through his real estate portfolio. Well, we already know that he's got 33 grand in cash flow, right? We see that on the tax return. It shows 33 grand on his 3-property portfolio. So we know that we can at least offset 33 grand. Well, the kicker here is that if we offset 33 grand, it's also going to drop his adjusted gross income, which means that if we show a loss on his Schedule E's, he'll actually be able to take some of that loss deduction, not fully, but he'll be able to take more of it in this year because his AGI is being reduced, meaning that he's not hitting the threshold or the phase out threshold, where at 150 grand of adjusted gross income, a non-real estate professional not able to deduct any real estate related losses. That's at about 150 grand in adjusted gross income. Well, if we can get him closer to 100 grand, which is the start of that phase out period, we actually can not only offset the 33 grand in profit, but we might be able to take a little bit of a loss deduction as well to offset his W-2. That's exactly what happened in this scenario. We shoot off the 3 property addresses to our cost seg specialist, comes back with a $400,000, what's called a 481A adjustment. This is the benefit of cost seg. This cost seg analysis allows taxpayer A to accelerate $400,000 on his 3 properties of depreciation to take all in 1 year. The greatest part about cost seg is not only is it acceptable on the federal level, California conforms to this part of the tax code. So after we did the cost seg, once again, he's not a real estate professional, so he's only allowed a portion of the 400 grand in the first year, but he's allowed about 45 grand of that loss. So now all of a sudden, instead of showing 33 grand in profit, he's showing an $11,549 loss on his Schedule E. Now, instead of owing the government, he's getting back close to $6,000 in IRS refund. And on the state side, he flipped from owing $4,200 to getting back close to a $1,400 state refund. It's about a $14,000, $15,000 delta. And he said, no brainer. And he said, well, what happens to the remaining portion? If I'm only allowed $45,000 of the $400,000, what happens to the $355,000 that's left over? Well, taxpayer A doesn't use it, but he doesn't lose it. So that $355,000 of cost seg election carries forward into 2022 and now offsets any cash flow that he has in 2022. Let's say that taxpayer A decides to buy 0 properties moving forward. He likes his 3-property portfolio. He did the cost seg in 2021, and he doesn't want to buy anything else. Basically, for the next 9 to 10 years, he can have $33,000 in cash flow and pay nothing in federal income tax on the real estate cash flow. That's not what taxpayer A wanted to do, though. Taxpayer A wanted to save that money, put it towards a down payment plus extra savings that he has, and buy more real estate. So fast forward to, I haven't met with him this year, but fast forward to last year, 2023, when we were doing 2022s. 2022, he did a cost seg on another property. 2023, he had bought a new property, which we cost seg. And I expect when we meet in the next month or so, when we do this tax return, that we are going to have close to $800,000 in cost seg elected depreciation deductions, meaning that he could have $50,000 to $100,000 of cash flow over the next 8 years and literally pay nothing in federal and state income tax because he has these elections in place and this accelerated benefit. Now, I'm hoping that by 2025, he can go into full-blown retirement. Then I can make the real estate professional election, and we won't need to carry those losses forward anymore. At that point, when we make the real estate professional election, it offsets all and any of his maybe retirement income or W-2 income. And if he's showing negative adjusted gross income in that year because we're able to make that real estate professional election, guess what we're going to do with his traditional IRA income? We're going to do a Roth conversion because he's already at a 0% tax rate. We're going to convert tax-deferred retirement income into tax-free growth retirement income. I am not expecting the 50 plus people listening in today to follow my mouth because I speak really fast. I'm not expecting you to absorb all of this information. That is not what I'm here to do. I'm here to whet your palate, to give you enough information to understand that, hey, you might be working with the wrong tax advisors if you're not getting this kind of advice or this kind of strategy implementation on your returns, but also to let you know that these are things that are available, not for the multi-millionaires of the world, but for the individuals who are what this guy's making $120,000 in W-2 income. He's got a 3-property portfolio. He's not a millionaire, but cost seg worked for him. And as long as taxpayer A does not sell these properties in the next 5, 10, 15 years, or he keeps them, he's got 1 child. If he keeps them for his child and he never sells them, this massive cost segregation benefit, this depreciation deduction, will never have to be recaptured. He'll never have to pay tax on it, and he can kick that tax can down the road until he kicks the can. I came up with that saying, by the way. I know I love saying it because I think it just goes hand in hand with what I do as a tax professional. But keep all of this in mind. It doesn't mean that you have to be a millionaire to elect some of these things on your individual tax return. So keep all of that in mind. Now, when taxpayer A decides to sell a property, let's say he doesn't like the tenant, he doesn't like the area, or let's say he wants to take that property and do an up leg into a higher end property in a nicer neighborhood, more foot traffic, higher rent cash flow. Instead of selling it outright and taking the cash, which would trigger this massive tax implication, not only on the capital gain side, but also recapture depreciation, he can 1031 exchange that property and all of that capital appreciation into a new property, bringing more cash to the table, maybe even more financing, and go into a higher value piece of real estate. And avoid, not evade, but properly avoid paying the income tax on all of that depreciation benefit that he got during the cost seg election year. So Section 1031 is still in play. Even though it's been on the chopping block for a while, I doubt that the federal government will ever change Section 1031. It's one of the oldest parts of the Internal Revenue Code, dating back to, I believe, 1904, if I'm not mistaken. And once again, the government has tried to nix this. They've tried to limit it. At the 23rd hour, right on cue, they decide not to change Section 1031. So this is your scapegoat. one of the holy grails under the Internal Revenue Code. Make sure that before you enter into escrow, you understand some of the tax implications, or not some, but all of the tax implications by liquidating real estate versus exchanging your properties. Now, as we get to the end here and we do Q&A, because I know I'm running out of time here, I did want to mention a couple red flags that you want to look out for every single year on your individual return. Excessive credits and deductions compared to income. When you have negative adjusted gross income through a cost seg election, yeah, it does increase your audit risk a little bit, but this is an election that's allowable under IRS code. And if filed correctly, not only filed correctly, but filed on time, right, with the correct professionals backing you and audit representation in case that audit risk does happen or that audit chance does happen, you should be good. I don't think that cost seg is a red flag at all. But when you have excessive credits on the solar side of thing, energy efficiency related credits, deductions that offset all of your income, like travel costs. If you use travel and meals and entertainment to offset all of your self-employed income, yeah, those are highly audited items that might throw up some red flags with the IRS. Missing or underreporting income. You got to make sure that whatever hits your bank account in rental income or self-employed income, that you report it accurately. I can't stress this enough. Underreporting income and missing income is the biggest red flag under current and future and past internal revenue codes. Refundable credits, where your income is so low that the government is actually paying you for being a low income taxpayer or a low income US citizen, that is also a high risk audit item on an individual return. If none of those apply to you, you overall have a pretty low risk for audit. And we're going to get into audit ratios in a second here. Okay. Audit percentages. This is going to blow your mind, by the way. Partnerships. So multi-member businesses have less than a 0.1% chance for audit. S corporations have less than a 0.1% chance for audit. C corps, a little bit higher of a risk for audit. These are the Amazons, the Googles, the eBays, the SpaceXs of the world. Companies that have over 100 shareholders have $10+ million in revenue. C corporations have a little bit higher risk for audit. Get this, personal tax returns have less than a 0.38% chance for audit. So when you go to bed at night fearing what you've done on your return, just think back to the statistics, right? These are pretty darn low statistics. Even if you think that you were aggressive on a certain part of your return, or if you misreported something on a form, just understand that the audit risk is still pretty low. Now, you obviously want to let your preparer know, hey, I think I made a mistake here. I think I overreported or underreported. Talk with your tax advisor, see if it's worth amending. If it is, simple correction through what's called a superseded return to pull the original filing from the IRS's computer system and replace it with a corrected return. Sometimes you don't even have to amend it. You just have to file what's called a superseded return. Okay, so keep all of that in mind. Most audited returns, get this, income under 25 grand and income above 500 grand. If you're in the $25,000 to $500,000 threshold, your individual return has the lowest audit risk out of all tax filings across the US and all states. So a lot of people don't understand that. Why under 25 grand? Well, under 25 grand, let's say that I file a return, married filing joint couple making 23 grand of income, but they have $35,000 in property taxes, right? The government's going to wonder, okay, well, one, how can you afford that home with $35,000 in property taxes? Two, you've got 3 dependents on your return. How are you surviving, right? Plus, under 25 grand will probably kick in something called an earned income tax credit, which is once again one of those refundable credits where the government is actually paying you for being a low income earner. So just be aware that the government's focus is above 500 grand taxable income, not gross income, but taxable income, and taxable income under 25 grand. Just keep all of that in mind. Hopefully it'll help you sleep a little bit better at night. Now, the reason why Sense Financial and Robert Hall and Associates, the reason why we do webinars together is because the power of this relationship is really something that should be written in the books from here until the end of time. I mean, the amount of clients that I send to Dimitri to help assist with solo 401ks, structuring a retirement plan so that we can defer money into something that can be more diversified retirement-wise than just investing solely in stock market investments. The power behind that is something that I can't even explain. It's I'm a real estate investor. I do enjoy short-term and long-term trading, but with my retirement accounts, I can diversify within that as long as it's a solo 401k or a self-directed IRA. If I just have a traditional 401k with my employer, all I can invest in is stocks. But if I have a solo 401k or self-directed IRA as a self-employed individual, as a property management company, and I have the ability to defer money into retirement plans, why would I ever just stick myself in something that was locked in to only stock investments? Why would I not want to plug it into something where I can still invest in stocks under a solo 401k self-directed IRA, but I can also acquire real estate? I can also invest in commodities. All of those things that were mentioned at the beginning of the webinar, I can diversify my retirement portfolio. As a real estate person, a real estate minded person coming from a real estate lineage, in my own family tree, I understand real estate more than I understand the stock market. I'm still trying to grasp how to day trade. And I've been doing it for close to like 8 or 9 years now. And I'm still trying to grasp the concept behind it. It's been a very strange 5-6 years running in the stock market, but money has been made. But I know real estate more than I know stocks. I know business more than I know stocks. And so I want my clients to understand that you don't have to lock yourself into just stock investments. You can lock yourself into a portfolio that can be diversified into other sorts of investments that you might know a little bit more about and have more control over. That is the power behind retirement, just traditional retirement investing versus self-directed investing. And that's why our relationship with Sense Financial is so special, because we speak the same language. So I'm glad that everybody's able to log into to today's webinar. We're working with somebody like myself or with a Robert Hall & Associates senior consultant, save you money and reduce risk of audit? Absolutely. I mean, if you try to prepare your own tax returns, by all means, tip of the hat to you, because the tax code changes every single year. Sometimes, especially during the pandemic, the tax code was changing by the quarter. Okay, so if you are filing something based on advice you got 3 years ago and you're applying that on your tax return for 2023 or 2024, that might be old information. So filing with a tax advisor can help you, reduce liability, obviously, because we try to find all the tricks of the trade and apply those on strategies on your tax returns. But it also will reduce your risk for audit because we know what the government is focusing on at any given time throughout your life. Doing this for 18 to 20 years, the audit risk in 2004, 5, 6, 7, 8, 9, and 10 during that last kind of recession, the audit focus was much different than where the focus is today. The focus today is on things that weren't even available back in 2004, 5, 6, 7, 8, 9, and 10, right? So absolutely working with a licensed tax advisor will help you save money and also reduce the audit risk. We do offer free consultations. Let's open it up for Q&A. I don't want to keep people much longer on this. If you want a free consultation, shoot me an email. My email's right here on the screen, TonyWatson@RobertHallTaxes.com. We'll get you set up with that free consultation as soon as possible. If you're looking to onboard for 2024 preparation, we start opening up our calendars in, I think, mid-November for next tax season. So if you've already filed for 2023, you don't want to do the free consultation, keep our information, reach out to us in mid-November and get on the calendar for this coming tax season. This, once again, is meant for a free 30-minute, either in person or over the phone or FaceTime or Zoom, or what we're on Zoho webinar right now. However you want to connect with us, it's 30 minutes free. So we can review prior year tax returns and kind of advise moving forward. If we feel like there's enough questions to warrant an actual full-blown hour consultation, we're very transparent about our fees. We're very transparent about how we can assist you. And if it needs more attention to detail, our advisors will advise to extend the meeting time and maybe set up another time to hop on the call. Okay. But let's hop into Q&A here. Let's go over to the chat box. I think I see some.
Yeah, there are a couple, man. Great presentation, Tony. Really appreciate that. I took a lot of notes myself. I have like 2 pads going, so
I try to cram a lot into the 45 minutes. I apologize. It's just I want to make sure that we hit a lot of these really, really great topics for people. I think they're really prevalent, especially entering into Q3 and Q4 with the election on the horizon. These are all things that are status quo with 2023. Could some of this information change? Yes, but I didn't want to touch on things that I know for a fact are going to change because I just don't know what the results of the election are going to be. So once again, I do webinars every single month. So after the election, I'll be back with all of the most up-to-date information that I can bring to you at that time. So
Robert is asking what was 4 again, and sorry, I'm going to cut in here because I know what he's talking about. He's talking about the very beginning of the presentation when you went to 1, 2, 3, and 4 on the items that you could write off and such.
Sure. 4 was legal and professional fees.
There you go. And then the follow-up question is related to that. What are professional fees? Is a lawn care professional contract, plumber, electrician, etc.? Is there a
Yeah.
list somewhere?
Legal and professional fees would be anybody you're paying for a professional service, a gardener, lawn care. That is a professional service in their industry, but it's not like a licensed professional, right? If you have a landscape architect, right, who's developing the landscaping around a pool and you're paying 10, 15, 20 grand for blueprint fees and things, yeah, that would be a professional fee. But what you pay to your gardener, your landscaper, a plumber, an electrician, a painter, a carpenter, an auto mechanic, those are more like outside services or repair costs. Legal and professional would be fees to an attorney, fees to a tax advisor, fees to a real estate broker, fees to a stockbroker, somebody who is a licensed professional. And so for the auto mechanic, for the plumber, you probably list that out into repairs, maintenance, plumbing, electrical costs on the Schedule E directly.
And then Brent is asking, where I get stuck is when I have a lot of equity on a property, low interest rate. I want to access some of that. This may be more of a one-on-one conversation to find out the situation, but basically it sounds like doing some kind of cash out refi potentially to unlock that equity on that. So I don't know if you have any advice on that or not.
I mean, the lowest interest rates I've found are asset or are interest rates with, if you have a large investment portfolio with a broker like Charles Schwab, for instance. Charles Schwab offers something called a pledged asset loan, where they can look at your asset portfolio and loan you money against your portfolio at a 6% interest rate. That's the lowest I've seen so far on the asset pledged loan. But it's not, and the great thing about that kind of loan is it doesn't impact your credit score, because you're not actually pulling a Fannie Mae, Freddie Mac loan. You're not pulling equity out of your home. You're just basically telling Charles Schwab, hey, I've got $1 million in a brokerage account. Let me borrow 300 grand against it without selling stock positions and whatnot. They're going to charge you 6% interest. That's a win for Charles Schwab. They're making 6% on the money. So there are unique loans like that. HELOCs right now, the best term I found is with Third Federal Credit Union. I actually applied for one as well. I did some remodeling to my house last year. I was able to lock in, I think, a 6.49% interest rate. Right now, I think it's like 7% or 7.89% with a 30-year fixed. That's pretty decent. For people who were buying properties 20 years ago, they talk about 13, 14% interest rates. 7%, it's not the best in the world, but I doubt we're ever going to see 2.95% again in my lifetime, at least, unless there's another pandemic or some sort of economic shift. I just don't see us dropping to that rate. Maybe we'll see mid fives again, probably not in the foreseeable future, at least, but we might see 6.5 after the election. Who knows? But I think that if you have assets like brokerage accounts or 401ks, you probably want to look at some of the products that the brokers have available for you versus going and pulling equity from your home at 7%.
There you go. Good advice. Chris says, great presentation. Thank you, Chris, on behalf of Tony. What other state, Michael's asking, what other states besides California resident income worldwide or in other U.S. states? I'm not sure I understand the question, but maybe.
Last time I checked, it was about 7 or 8 states. I'd have to look up the list again. It's probably pretty easy to find online. I don't want to give you the wrong state information. I'd have to look it up again. It's been a while since I've looked, but it has grown because other state codes have changed. I think in 2021, when I did actually look up the list, I should look up the list moving forward, but I do know that when I looked it up, it was 7 states. California is the worst. New York is one. So I can give you 2 states right there, California and New York, but the other states, you'll have to look up the list online, or I can get that to you during a free consultation.
Tony, I want to be respectful of your time. Do you have time for the few more that are up here?
Sure. Yeah. Okay. Let's roll with the remaining questions here.
All right. Brent is saying I don't know what PT2 means, but without just refi at a higher rate. I think that's a follow-up to his question.
Yeah. So once again, we talked about refi, but you're looking at a HELOC at about 7% plus interest rate. Like I said, going to a brokerage firm or maybe even borrowing from a parent's 401k, which is limited to $50,000, but at least the interest that you're paying is going right back into your parents' retirement account. They're playing piggy bank with their 401k. So like I said, there's a couple other products out there. I think that if you don't have large brokerage accounts, large stock investments, or 401k investments, your best bet is probably going to be the HELOC at this point.
Great. And then George or Jorge, apologies if I'm not saying it right. What do you think of Wyoming statutory trust to avoid $800 franchise tax in California? Is that a good idea?
So I could tell you right now that I've done webinars with many professionals that say that they have a workaround for the FTB fee. Which, once again, with these professionals being who they are, if you follow their advice, that's fine. But I look at case study in this situation. California is ruthless. If you register in another state, I know that there is one popular way to avoid California FTB fees, which is setting up a non-revocable, it's a special type of trust, which then owns the property and the beneficiary is your corporation. There's some way that you structure it in that way. You're talking about like a $10,000 to $15,000 structure to avoid an $800 franchise tax board fee. So if you've got tens of $1,000,000 in wealth, paying all of that money to set up that kind of structure just to avoid $800, it seems kind of silly to me. But California is very specific in their code. If you are a registered voter in the state of California, you spend more than 51% of your time in the state of California, you generate revenue in the state of California, you have California plates, California address on your driver's license. By definition, you're a California resident. That means that if you file as an LLC or an entity outside of California, you also have to file foreign jurisdiction in the state of California and pay the supplemental $800 franchise tax board fee. So I have seen case studies that override a lot of this, the Wyoming, Delaware statutory trusts, and California still comes after them for their income tax. If we're talking about millions and millions of dollars, I have attorneys that you can talk to about how to better structure things. But if we're talking about, $40,000, $50,000 in cash flow, the $800 is an opportunity cost. All right. It's a cost of doing business, essentially. And what you get by having yourself structured in Wyoming is greater asset protection. But at the end of the day, after the $800 write-off, if you're in a higher income bracket, you might be saving 40 cents on the dollar. So that means that 40% of $800 is saved, and you're only coming out of pocket, $500 in franchise tax board fees after the tax savings. So, I understand what you're saying because California has the highest filing fee, but is it worth dodging the state of California on the $800 filing fee if 3, 4, 5 years down the line, state of California catches wind of this and they assess you 4 to 5 years times $800 plus civil penalties and possible tax evasion penalties, where you could end up in California state court? It just doesn't make sense to me personally. But once again, there are some very expensive structures that I've seen that have been set up to avoid state income tax or the franchise tax board fees. But you're talking about $15,000 to $20,000+ that you pay a legal advisor to set all of this up for you. So just got to be careful. I guess that's my best advice, Jorge or George, on that end.
Good answer. All right. Sam asks, what happens if you do cost seg and take this deduction in 1 year? Are you able to deduct the normal property depreciation on the following years?
So cost segregation doesn't take the full building value and accelerate it. What it does is it takes, through this cost seg analysis, which is done by a third party, they take whatever part of the property is considered to be 20-year or shorter improvement property. There will still be an allocated 27.5-year lifespan for some of the property, some of the building, and on commercial, some will be allocated for 39 years. So you'll be able to accelerate, let's say 40 to 50% of the property value. Once again, I'm estimating, I'm using a fictitious number here. Let's say you're able to accelerate 40 to, let's use 60% of the building value you're able to accelerate. 40% of the building will still be carried over 27.5 years. But that 60% that you're accelerating is all in 1 year, and that's gone. That's built into the basis of your property, and you're only taking 40% of the building value now over 27.5 years for residential, 39 years for commercial.
All right, great. Hey, everybody, reach out to Tony's office. Take advantage of that consultation that he's offering. You have nothing to lose. And Tony, we really appreciate you coming on with us. Thank you very much.
Thanks again for having me.
All right, take care, everybody.
Take care, everyone.